Hi guys, what's up? Welcome back, and in this video I'm going to be talking about cash flow and capital appreciation, and specifically why it's such an important topic when investing in the Teesside property market. We're going to be looking back at property prices in Teesside over the last 20 years because that's what we do. We make investments based on numbers, on due diligence, we make informed investments. I'll also explain why I never invest for capital appreciation. Yes, it'll depend on what type of investor you are, what your goals are, and where you are on your journey. And I want to share with you an example of an investment that we made in 2008 and how that's performed since. So with that said, let's get into it. Okay guys, so if we look at property prices in Middlesbrough at November 2000, we can see that average prices were £42,527. In 2010, there were £112,212 was the average price, which represents an increase of 164%. Property prices from 2010 to 2020 in Middlesbrough didn't rise at all. There was a £500 increase. If you look at prices in Stockton back in 2000, the average property price was £50,724. It was a 143% increase from 2000 to 2010, where prices were 123,000. And then from 2010 to 2020, prices went up to 133,410. So that was a slight 8% increase. If we look at Redcar and Cleveland, back in 2000, prices were just slightly over 50,000, rising to 118,000 in 2010. 2010 to 2020, a slight 9% increase in property prices in Redcar. And finally, Hartlepool, this gets even more interesting. So average property prices in Hartlepool were £42,168 as of 2000. In 2010, property prices following exactly the same pattern more than doubled to 111,000. But then in 2020, average prices in Hartlepool were £109,000. To summarise, as we can see, prices in Teesside more than doubled from 2000 to 2010. Since then, there's been almost no growth, with marginal increases across all the Teesside towns. And that brings us nicely to the example that I want to talk about, the property that we bought in 2008. We ended up picking it up for £80,000. We have a mortgage on it of just below £70,000. So our cash required to do the deal was around £12,000. We've been renting the property out since day one for £550,000, and with a mortgage payment of just above £200. Our monthly profit every month since we bought the property is £342, or £4,104 per annum. And if you've seen my other video on how to calculate your return on investment, you'll know that's a 34% return on investment, meaning we'll get our money back in approximately 3 years. If we take our annual profit and times it by the number of years that we've had the property, we've made just short of £50,000 profit since we've had the property. Now, when we went to get this remortgage and pull out some equity, the valuation come back exactly the same. It come back as £80,000, so there was no growth in that 12-year period, but the property had made us just shy of £50,000. And that's why the messages for this video is don't count on capital appreciation. Cash flow should be at the forefront of your mind when investing, because really capital appreciation is nothing but speculation. Now, in the next 12 years time, do I think the property will go up in value? Absolutely, I think it'll go up in value, but I'm not counting on it. But what I am counting on is making just shy of £50,000 from the property, regardless if it goes up or down in price. The rent is going to stay the same, if not increase. So it'll be interesting to see people's thoughts over their investments done over the last 10-20 years. They've not increased in value, but they've still been making monthly cash flow. Let me know in the comment box. And with that said, I'll see you in the next video.